Good morning. Happy Monday out there. Hope everyone had a great weekend. Today, I just wanted to talk very briefly about how to determine if a stock is good or not. How to determine if it's trading at a fair price. You can't go just by the names that you know. That is a terrible strategy. We saw that last week with Yelp. Yelp is a very common, everyone knows the name. A lot of people love the company, but their stock got absolutely destroyed last week, and the future is not looking very bright for those guys. So you have to understand, at least in basic terms, ways to evaluate a company and their financial health. And one of the most common tools used in doing that are known as multiples. Um, Multiples are when you take two metrics for a company and you divide them, which gives you a ratio or a multiple. And the most basic ones, the best ones really, are having to do in some way with cash flow. So today I wanted to talk about probably the most common multiple, and that is known as the PE ratio, or the price to earnings ratio. The two metrics used in this ratio, as you can see, are the price of the stock and the earnings per share. Earnings per share is calculated when you take the company's entire earnings and you divide it by the number of outstanding shares in the market, you get an earnings per share number. So I wanted to kind of illustrate this, and I had mentioned before there's two main types of stocks. That's growth versus value stocks, where growth stocks are these ones that are in kind of more cutting edge industries, a lot more speculative. They have the potential for explosive growth, and yet they also have a lot more risk on the downside as well. So whereas value stocks are much more stable, steady, not very volatile companies. They're more in kind of bedrock industries in the economy, and they're often willing to pay their shareholders a dividend as a thank you for owning the stock. So starting with a value stock, we have Delta Airlines here. Very common, everyone knows them. Their stock price was opening today at about $56.65 per share. And as of their most recent report, they reported $5.08 of earnings per share. So that gives them a PE ratio of about 11.15. So you could say the stock's trading at about 11 multiple. Okay, that means that investors are willing to pay 11 times the amount of earnings for one share of Delta stock. So it's certainly trading at a premium, but that is pretty reasonable. That's pretty good value in most investors' eyes. Anything below a 20 is usually considered a pretty fair value as far as PE ratio goes. When you get into the growth stocks, I mentioned that these stocks are inherently more speculative. So when you say speculative, that means that it's less determined by underlying fundamentals. So you can see Amazon here, certainly a growth company, probably the most common company out there. Their stock opened at $1,712.43 per share today, and they had about $12.63 of earnings. So if you do that division, they're trading at a multiple of 135.58, almost 136 multiple. So that means that investors are willing to pay 136 times the earnings of the company for one share of its stock. So you can see that that's trading at a much higher premium than Delta Airlines and a lot of those other value stocks. So I wanted to leave that for you guys just kind of as an illustration of the difference and a little explanation of some basic valuation metrics and PE ratio and multiples. These are very common things that you should know before investing a dollar in any stock. And I guess I'll just leave you with the question here. It is a matter of some debate, but why do you think people are willing to pay such a high multiple to own shares of Amazon? That is a very high multiple. Why do you think they're willing to pay that much to own shares of Amazon? Hope that gets at least someone thinking. Have a great day.